A balance sheet shows growth that never appears on a tax return. Over years, ownership expands. Shares multiply in value. Land appreciates. Private holdings compound quietly. The numbers rise, but no sale takes place. No gain is declared. Nothing converts into income. Daily life continues. Homes are purchased. Capital is deployed. Liquidity appears without a corresponding spike in reported earnings. The separation is deliberate. The system draws a clear line between value that is realized and value that remains owned. As long as appreciation stays on paper, taxation waits. Over decades, that waiting becomes powerful. Assets grow uninterrupted. Income remains controlled. Transfer eventually occurs under rules that recalculate everything at the moment of inheritance. 3 stages shape the outcome: buy, borrow, die. The structure begins with a single decision: what is acquired and how long it is held. The shift begins with ownership replacing income as the primary objective. Traditional financial paths revolve around earning. Salary arrives, taxes are withheld, and whatever remains is saved or invested. Every cycle begins with taxation. Ownership follows a different rhythm. Capital is directed toward assets designed to appreciate rather than distribute cash. Growth-focused equities that reinvest profits internally. Commercial properties held for long-term value increases. Private stakes in companies expanding behind closed doors. Appreciation does not trigger taxation until a sale occurs. Value can rise for years without crossing the realization threshold. A property purchased and held appreciates steadily as surrounding development expands. Shares in a growing enterprise compound as earnings are reinvested. Equity accumulates quietly in the background. No transaction, no taxable gain. The distinction appears minor at first. Over time, it reshapes the outcome. Income is taxed immediately. Appreciation is taxed only upon realization. By prioritizing assets that grow without producing large taxable distributions, capital compounds without interruption. The tax system waits for an event that does not occur. Ownership duration becomes strategy. Short-term exits are avoided. Gains remain embedded. The portfolio strengthens without triggering friction. The foundation of long-term wealth is not rapid turnover. It is controlled acquisition paired with patience. Everything that follows depends on this first discipline, buying assets intended to be held. Acquisition alone is not the strategy. Selection determines whether growth compounds quietly or leaks into taxable events. Assets built for appreciation behave differently from assets built for income. Dividend-heavy holdings distribute cash regularly, creating predictable tax obligations. Rental properties structured purely for cash flow generate taxable income each year. Even frequent trading converts paper gains into realized ones. A different approach favors internal growth. Companies that reinvest profits expand value without distributing earnings. Land held in developing corridors increases in worth as infrastructure improves. Private ownership stakes compound as revenue scales and valuations rise. Art, collectibles, and long-term equity positions appreciate without sending checks that require reporting. The emphasis is simple: allow value to build without forcing recognition. This approach demands restraint. Market surges tempt liquidation. Headlines encourage profit-taking. Conventional advice suggests locking in gains. Restraint preserves the base. When assets remain intact, compounding continues on a larger foundation. Selling interrupts that process and introduces taxation at the point of realization. Holding defers it. Over extended periods, the gap between tax turnover and untaxed appreciation widens dramatically. The portfolio evolves from a collection of investments into a reservoir of embedded gains. The objective is not immediate liquidity. It is accumulated strength. With sufficient scale and stability, appreciation becomes collateral, and that changes everything. Appreciation sitting on paper does not pay for expansion, acquisitions, or daily expenses. At some point, access to capital becomes necessary. The conventional path would require selling, A portion of the portfolio would be liquidated, gains would be realized, and taxes would be triggered. Ownership would shrink in exchange for cash. There is another route. Financial institutions lend against assets that have grown in value. Securities-backed lines of credit extend borrowing power based on portfolio size. Real estate holdings support financing without transferring title. Private equity positions strengthen balance sheets used to negotiate structured loans. Cash enters the account as borrowed capital. Borrowed funds are not treated as income. No shares are sold. No property changes hands. The embedded appreciation remains intact. Interest is paid, but the underlying assets continue to compound. If the rate of appreciation exceeds the cost of borrowing, overall wealth expands despite the debt. Liquidity is achieved without dismantling ownership. As asset values increase, borrowing capacity expands alongside them. Credit lines are adjusted upward. Terms improve with scale. Access becomes easier as collateral strengthens. The portfolio remains whole while capital circulates externally. What would have been a taxable sale becomes a leveraged position. Ownership is preserved. Appreciation continues. Taxes tied to realization remain deferred. The structure evolves from passive holding into active leverage, without crossing the threshold that triggers capital gains. Leverage, when structured carefully, transforms dormant appreciation into usable capital without disturbing the foundation beneath it. A portfolio valued at $10 million does not need to be reduced to produce liquidity. A portion of that value can secure a credit facility. Funds become available while the underlying assets remain untouched. The balance sheet shows both collateral and liability, yet ownership stays intact. Interest payments are predictable. Appreciation is not. But over long horizons, growth has historically outpaced conservative borrowing costs. When that spread exists, the portfolio continues expanding even as capital is accessed. Refinancing becomes possible as valuations rise. Credit limits adjust upward. Existing debt can be rolled into larger facilities under improved terms. The cycle sustains itself as long as asset values remain stable or increasing. Risk exists. Market declines reduce collateral value. Excessive borrowing magnifies exposure. Prudent leverage leaves margin between asset value and outstanding debt, ensuring flexibility during volatility. Used strategically, borrowing replaces liquidation. Lifestyle expenses, investments, and business expansion are funded without dismantling the compounding base. The original holdings remain positioned for long-term growth. Ownership continues, appreciation continues. Liquidity flows without triggering realization. The final stage completes the structure, not through expansion, but through transfer. Time eventually moves ownership forward. Assets accumulated over decades, shares, property, private holdings, shift to the next balance sheet. The transfer is not a sale. No exchange takes place in an open market. Title changes hands without converting appreciation into realized gain. Under current federal law, inherited assets receive a step up in basis. The valuation resets to fair market value at the moment of transfer. The original purchase price no longer determines taxable gain. An asset acquired long ago for $1 million and now worth $9 million is inherited at $9 million. The embedded $8 million increase does not carry forward as a taxable gain. If liquidation occurs immediately after transfer, capital gains taxation is calculated from the new basis, not the historical one. Outstanding loans secured against those assets can be repaid through selective sales without triggering decades of accumulated capital gains. The debt is settled. Ownership continues at a recalibrated valuation. Appreciation that remained unrealized during life does not suddenly crystallize into a tax obligation at death under current rules. The ledger is rewritten. What was once deferred becomes neutralized. The compounding base survives intact, positioned to begin again under a new ownership structure. The sequence approaches completion. The reset does more than erase embedded gains. It renews the cycle. With basis adjusted to current market value, the inherited portfolio begins its next phase without the burden of historical appreciation. If assets are retained, future growth compounds from a higher starting point. If partial liquidation occurs, taxation applies only to gains beyond the reset valuation. Debt accumulated during prior decades can be extinguished strategically. Portions of the portfolio may be sold without triggering the capital gains that would have existed under the original purchase price. What remains continues forward with a clean foundation. Estate taxation may apply, depending on thresholds and jurisdiction, yet capital gains tied to long-held appreciation are neutralized through the step-up mechanism. The distinction matters. One addresses total estate size, the other addresses embedded growth. The structure completes itself quietly. Acquisition prioritized appreciation. Borrowing replaced liquidation. Transfer recalibrated valuation. No dramatic exit. No large taxable realization event. No interruption in ownership continuity. What began as a disciplined buying strategy evolves into intergenerational durability. The compounding base survives market cycles, political debates, and shifting tax rates because realization was consistently postponed. The cycle stands ready to repeat. Understanding this structure changes perspective. Income and ownership follow different rules. Realization determines taxation. Duration determines compounding. The mechanics are public, embedded within existing law, and accessible only at certain scales, but the principles are visible to anyone willing to study them. If this breakdown clarified how appreciation, leverage, and transfer interact, continue exploring how financial structures shape long-term outcomes. Examine policies. Question assumptions. Look beyond surface tax rates. Knowledge of structure does not require extreme wealth. It requires attention.